When building a dividend portfolio, the core that I like to insist on is having a well-diversified basket of high-yielding blue chip, and by blue chip I mean defensive and durable business model, as well as a strong investment-grade balance sheet, but companies that also are growing their dividends consistently through thick and thin. And the reason why I like that having as my core is because I know I'm getting a good stable base of income that I can count on over the long term, and the purchasing power of that income is going to be protected against the erosive power of inflation over the long term. Now, a great way to do this is just buy the Schwab US Dividend Equity ETF. Has a solid dividend yield of about 3.7%. 0.06% expense ratio, diversified across a little over 100 of these blue chip dividend growth stocks, has a great dividend growth track record with a 10-year CAGR of 11% per year dividend growth rate. And so you get, solid current income with growth rates that crush inflation over time with that nice diversification across numerous sectors. Now that's one way to do it. And I don't have a problem with just going with SCHD. The thing is, the 3.7% yield is just a little bit on the low side for me. And I think for many, especially those who want to live off of retirement income, I'm not at that point yet, but even for me as someone, I like to have the yield a little bit higher so I don't have to rely on growth so much, because I think one of the concerns about SCHD is, are they going to be able to sustain that dividend growth rate? I don't think they are. I think it's going to slow, but it'll still be well above inflation, so I think it's still a solid dividend growth fund. But if you're really trying to maximize total returns, I like buying individual stocks more. In this video, I'm going to discuss 3 dividend growth stocks that I think are really good for people who just want to be able to buy a dividend stock and ride it for the long term with a combination of attractive current yield and attractive growth rate that's going to be sustainable through thick and thin. But before I get into these picks, if you could please subscribe to this channel if you would like to get regular dividend content, whether it be my top picks that I give updates on, or just individual dividend stocks and ETFs and funds that I like a lot right now, or some of my lessons learned and investing philosophy and strategy. I put out numerous videos each week. I'd really be appreciative to have your regular viewership. Thank you so much. Okay, so the first one I'm going to talk about today is one you've probably heard about many times, is Realty Income, otherwise known as the monthly dividend company. And it's the quintessential blue chip dividend growth stock that also pays a high current yield. Its current yield is over 6%, so it's definitely up there, well above even SCHD's yield and about 5 times what the S&P 500 offers right now. But it owns this huge, well-diversified portfolio of triple net lease real estate, mostly retail, well over 10,000 properties by now. It's also growing in Europe with its main lion's share of its properties being in the United States. Has an incredible track record going back about 3 decades, back to the 1990s, of growing its dividend year after year and really quarter after quarter. And it pays out monthly dividends. So you get that regular, these days 0.5% yield every single month. That adds up to about a 6% annual yield. So it's a really, really powerful dividend growth stock. The other thing that's really popular about it, though, is that its triple net lease business model makes it very defensive and durable because of the diversification, because of its recession resilience, its resistance to e-commerce headwinds. It's done very well through recessions, whether it be COVID or the 2008-2009 financial crisis. It's done very well in those. It's done well in the face of technological disruption and innovation. And it's just delivered very, very stable cash flow growth year after year because it has those fixed rent escalators in its contracts. Again, its counterparties are typically very high quality. A large percentage of them are investment grade, so they pay their rent year in, year out, regardless of economic conditions. And it just pays out, 75-ish% of that to shareholders as dividends, reinvest the rest along with some debt at a very attractive rate. Again, they're very skilled at what they do. They can earn a nice risk-adjusted spread on that with their low cost of capital due to their A- credit rating. And it's a very proven, nice business model that just has consistently compounded returns for shareholders over the long term. Today, it trades at a steep discount to its net asset value, still has solid growth prospects, attractive current yield. I think it's a great dividend grower to add to your portfolio these days. Another one I like a lot is Enbridge. Now, Enbridge is a Canadian company, so keep that in mind. It declares its dividends in Canadian dollars. There's a Canadian withholding tax if held in a taxable account. In an IRA, you should check with your broker, but you shouldn't have that applied due to a tax treaty with Canada, but some brokers like Robinhood still apply it, so just keep that in mind when investing in it. If you invest in your taxable account, you can reclaim the withheld taxes at tax time, so that's something nice to keep in mind. But ENB, or Enbridge, its ticker symbol is ENB, it's got a lot going for it. It has a very well-diversified midstream and utility portfolio, and so it's really a hybrid between your traditional pipeline midstream stock and your regulated utility stock. virtually all of its cash flows come from either contracted or regulated assets, and so has virtually no commodity price exposure in the near term, making it a very defensive and durable, stable cash flow generator. It has a BBB plus credit rating with lengthy terms of maturity on a lot of its debt. So again, it has a very solid balance sheet, has very adequate dividend coverage. It pays out well over 6% dividend yield. So again, nice yield, nice safe coverage, and is growing its dividend at a 3 to 5% annualized rate moving forward. It expects to grow its EBITDA even faster, and it's going to use that extra EBITDA growth to help bring down its leverage ratio a little bit to further secure its rock-solid investment-grade credit rating and invest in numerous attractive growth opportunities, whether that be in its renewables segment, its regulated natural gas utilities, whether it be in its crude oil pipelines or in its natural gas pipelines and NGLs, as it's trying to take advantage of the NGL export boom, which is really accelerating, as well as the natural gas midstream infrastructure boom that is being capitalized on as well, to be able to provide adequate flows of natural gas to all these data centers being built out in North America right now to fuel the ongoing AI boom. Okay, and the third dividend growth stock I'm going to mention right now is not particularly attractively valued at the moment. It's Main Street Capital. It's a business development company, as it trades about a 90% premium to its net asset value. Now, it does deserve to trade at a nice premium to its net asset value because it has a low management cost due to its internal management, has a phenomenal long-term track record of compounding shareholder wealth over time. So again, I don't think just because it trades at a premium, it means it should be avoided, but a 90% premium is way above its historical norms of probably 40 to 60% premium. And so investors who are buying MAIN today are paying way up for the stock. But it's still a very solid dividend grower. If you include the supplementals it's been paying out, it still yields around 7%, which is quite nice. Now, those supplementals may decline moving forward if the Fed keeps cutting rates, but still, it's got plenty of coverage on its base dividend, which is still, comfortably above 5%. And it's got a solid investment-grade balance sheet. Again, it's got that tremendous underwriting track record, and it's held up remarkably well in terms of underlying dividends and quality in the face of the great financial crisis, COVID crash, etc. Now, the stock will be volatile, something to keep in mind. But again, if you're wanting to have a company that benefits from increases in interest rates to balance out, say, Realty Income or Enbridge, which may suffer more from rising interest rates, MAIN is a very high quality option, and it's one that's proven to be able to keep its dividend stable or grow it over time, even through really tough times when many of its peers have had to cut their dividends. Okay, so there you have it. There you have those three ideas: Realty Income, Enbridge, Main Street Capital, all of which yield over 6% at the moment, have well-covered base dividends, have strong, proven business models, strong balance sheets, excellent management teams, and I think can help work alongside SCHD and a bunch of other dividend stocks to really provide a very powerful, reliable dividend growth core for your high-yielding portfolio. And these are the kind of stocks that I personally like to target a high-yield investor. I don't actually own any of those three at the moment, but I own a bunch very similar to them, but that trade at much more attractive valuations, but still have very similar quality and similar outlooks moving forward. And so again, hopefully this video added some value to you. If it did, please subscribe to my channel, give the video a like to help it get better distribution. It would mean a lot to me if you did that. And let me know in the comment section what you think of these three stocks, as well as others like them that you may think are even better picks right now. Thank you so much. See you next time.